Oh, it did auto record. That's very good news. Well, for people that are trickling in, it's like, why doesn't Zoom let everybody in at once? It's like three people, then five, then, oh, good, we're at 200 now. It's good everybody was let in at once. I like that. Uh, Welcome to Capital Markets Wrap, presented by Polly. I'm not Rob Chrisman. I'm Robbie Chrisman. He is at the TMC conference in Denver, which is actually where Marcus and Ira are. So I'm not sure what his excuse was for not joining us today, but I will be your host live from Fenway Park. As you can see, the mortgage industry has some interesting perks here. Uh, Very pleased to have both of you here. Rob Kessel will not be joining us today. He had a family matter come up. We wish him the best, and hopefully he'll be back on for the next show. As more and more you trickle in, we'll do a couple housekeeping things here. I would like to say a big thank you to Polly, the leading provider of innovative mortgage capital markets technology and the operator of the industry's first cloud-native, commercially scalable product and pricing engine. I'm going to give you guys some extra ad stuff here. Polly has revolutionized the mortgage industry with its modern data-driven capital markets ecosystem. Banks, credit unions, and mortgage lenders nationwide trust Polly's product and pricing engine, loan trading exchange, actionable data and analytics, and advanced AI and ML to automate and optimize the entire capital markets value chain, which helps their secondary teams operate faster, smarter, and more profitably. Marcus, the big news today out of Polly, since will this be like our Polly minute or Polly 90 seconds,
Yeah.
is that you guys just this morning, and I think it was broken in the Chrisman commentary, Daily Mortgage News, announced 25 million in new growth equity capital. It was led by 8VC. There was participation from a bunch of other existing investors. And this, well, let me let you talk about what does this mean and kind of give us why you're so excited about it.
Yeah, I'll hit on it real quick. So Poly raised additional 25 million from our current investor lineup, and I think that really just highlights what our investors are seeing, and that's strong, disciplined growth. And it's just an indication of clear commitment to Poly and our ability to continue to lead the industry with the cutting edge PPE. And we're seeing strong demand throughout this conference. And we're delivering strong ROI, and we're privileged to be partnered with several of the top 10 lenders in the U.S. and dozens of the top 100. And what this additional investment will allow us to do is really just double down on everything that's made us who we are today, including on kind of growing our pace of R&D, our innovation, implementation, and execution.
Very cool to hear. I know you're excited about it. Hopefully some good things coming from Polly down the pike. Ira, let's bring you in here.
Sure.
Can you see us? I can barely see you. What's
I can see you perfectly. My camera is still sporting a hangover, I guess, and blurry-eyed.
Well, cool. I had the pleasure of speaking at the New York MBA last week in Verona, New York, at the Turning Stone Resort and Casino, where, judging by how I did out there, they should have comped my room. But that's a whole different story. I had the pleasure of meeting Stephen Milner, CEO of US Mortgage, your boss. He has a whole book of Milnerisms. He loves ties. We compared ties. Do you have a favorite Milnerism?
There are many Milnerisms, and you can ask him for his little pamphlet or book if you want. But I one of my personal favorites is needs of the company outweigh the needs of the individual. And it takes some people, it takes that a little longer to learn and a little longer to implement. But I think that holds a huge meaning and a lot of meaning for whatever company you're working for. It's really it's all about the company and not any one individual.
So when I asked my dad about US Mortgage and Stephen Milner, he goes, Stephen is old school. And so working for a guy like that, old New York guy, what do you feel like has been lost in the newer generations of leadership that hope that it would be good for them to kind of remember what a Stephen Milner is so successful at, what he's good at, that they should hang on to?
Yeah, I mean, I think one of the main things when you ask that question, I thought of an instant answer, is he loves to sit down with an employee, a prospect, even a vendor, and hear their story. He wants to know where they were, where they've been, where they're going, where they are, and he truly wants to hear that stories. he'll ask you for your favorite song or your favorite band. And, he loves collecting information, personal information about employees. And it leads to sort of that caring touch, that personal touch. He'll be the one to call you on the phone call on your birthday, not just giving you a generic, card or things like that. So it's really that personal touch that I think, nowadays can be lost sometimes, especially in this virtual world we live in as we sit here on a virtual Zoom. You sometimes lose that personal touch, and Stephen loves that.
Love to hear that. Melanie, thank you for writing into the chat, telling me to breathe. Well, I breathe before we get into the Fed here. Marcus, give us a little scooch to your right so we can see the presented by Polly on there we go. Yeah, can you hang out there so we can people can love that. Love to see
There
that.
we go.
So good. Now that I've taken my breath, let's talk about the Fed a little bit. Let's get into it for this meeting. The Fed has basically signaled they're going to cut rates at the September meeting. There's still some conjecture about will it be 25 basis points, will it be 50 basis points. CPI tomorrow might deliver the deciding blow one way or another. I'm unsure about what I think they should do. I'd like to see 25 basis points. 50 seems a little drastic. Where do we go from here? Or I guess what my dad would ask you too is why are the Fed going where they are from where we are now, which is downward on the federal funds rate? Ira, let's start with you.
Yeah, I mean, listen, we've been sitting here at this federal funds rate for I've lost track of how many months now. We've been fighting inflation for the last few years, and with inflation finally starting to cool off a little bit, I think everyone's in the camp that it's about time for the Fed to start cutting rates. Hopefully lower costs for consumers, generate some additional activity. Obviously, one of the big factors in the Fed's decision making, now that they sort of felt comfortable with the inflation piece, is the employment situation. I think we've all seen those numbers. If we flash back to, I think it was Friday when we had the last jobs report, I think we all expected maybe a bigger reaction from that jobs report. But interestingly, it was more some of the conjecture from the Fed members after the job reports that sort of pushed the market a little bit. But I think we'll continue to see the Fed cut. They didn't want to cut too early. They didn't want to cut too late. And it's not an easy situation for them to deal with. But obviously, I agree we're going to see 25 in the next meeting. I guess between 100 and 125 for end of year. And I guess we'll need to see how things progress before we even start to look at next year.
Yeah, I had heard something like 240 to 250 basis points by this time next year, but that seems so speculative, especially considering how far the market has gotten ahead of the Fed in terms of its dovish hopes this entire cycle. But maybe the Fed, in terms of they were more hawkish than the markets were hoping for. Maybe they finally come around to, hey, we've put the damper on the economy. We've seen job openings drop. We've seen employment numbers drop. It's time to kind of juice it again. Let's see what happens. Marcus, when it comes to the why of all of this, why is the Fed going to do what the Fed is going to do?
I think exactly what Iris said, just with inflation normalizing a bit, I guess if you want to call it low threes normalizing. But I think the other thing is also the underemployed, which is upticking as well. And these are people who are working part-time jobs. They're not getting the jobs that they want. They're just working gig or whatever it is that's not full-time employment. That's upticking as well. I think there's just enough pain in the market right now where I do think that the Fed will cut 25. I think they'll go 25 in September, another 25 in November and December as well. So my money is on 3/4 by end of year. But it's exactly what you just said. By this time next year, that could be anyone's guess. I mean, if COVID-20 Megatron variant comes out, who knows what'll happen?
True. And I think I asked you this on a podcast that actually aired yesterday, Marcus. And so we'll reiterate your opinion for the audience, but I want to hear yours afterwards. How do you grade the job that Jerome Powell has done, at least in the last 12 months or so? Forget him cutting the Fed funds rate to zero, but over the last year, how would you summarize how you feel like he's done as the Fed chair?
I think in terms of monetary policy, he's done all right. I mean, it's a tough position to be in because you have to look back at the data and then you have to make sure the data is consistent, that you're not looking at an anomaly, you're not looking at an outlier, that inflation really is steady for months at a time, and unemployment or employment, whatever one you're looking at, is a trending value, not so much a blip in the data. So with that, and considering how, I guess, delayed they have to look back, I think he's done the right thing, and I think we're on the right path.
Check 1, 2.
Ira, thoughts on the job of Jerome Powell?
Yeah, I agree 100%. Listen, it's not an easy task coming back after COVID and all that, cutting down to zero, to now come up with a solution to that on the rebound. It's definitely not an easy situation. They were not put in a great position. One can argue they cut too much. So, lesson learned from that possibly. But I think in the last year, they've been pretty clear in what they want to do, what they want to see. And as you mentioned before, the market did get ahead of itself, even though the Fed was pretty transparent with what they wanted to do. So, that trust in the Fed, it's not like it used to be back in the days of Bernanke and Greenspan where you didn't know what the Fed was going to do. The Fed's been telling us exactly what they're going to do. And for some reason, the market just wants to get ahead of themselves. But I think he's done a fair job. Did they cut too much? Should they have cut earlier? That could be debated, but there's no sense in looking back at that now, right?
It's almost nice, this blackout period this week before the meeting, because it goes back to this cone of silence of like, we're not inundated with Fed speakers every day and we're parsing through it and nitpicking every little word. It's nice to breathe a little sigh of, just I don't have to hear what Raphael Bostic from Atlanta said or President Williams from New York said for a couple of days. That's good. So at the expense of sounding like every other show that's out there, I'm glad we got through our what's the Fed going to do, because I want to talk capital markets specifically. And Ira, let's start with you. What are capital markets folks paying attention to these days? My thought would be, we've seen rates drop a little bit. There's talk of early payoffs creeping back in. There's talk of what are servicing values. What are they going to do? Where are they creeping back in? What are you seeing as a capital markets guy out there? What's the chatter?
Yeah, the EPO chatter is probably one of the bigger topics right now. You have to balance the current servicers on their portfolios are going to be pretty aggressive on these loans. And, obviously loan officers and salespeople are hungry for business as well. So you sort of have to balance those EPO periods without paying that penalty versus knowing that those current servicers are going to be pretty aggressive in holding those portfolios. So we've been personally, at our company, we've been communicating with our sales staff saying, hey, these are the dates, stay in contact with your borrower, give them the heads up, let them know, what the situation is, and sort of trying to guide them through the process of understanding, listen, EPOs may happen, but do you want to keep that client? Do you want to keep that relationship open? So that's probably been the hottest topic, at least from what we're seeing right now.
So, but before I go to Marcus, can you explain why EPOs are such a pain in the neck for capital markets departments or for investors? Why this is such a thing they care about?
Yeah, I mean, listen, when we if we service a mortgage, right, we are valuing that mortgage with an assumption on how long that loan is going to be on the books. And we have, various prepayment speeds that are applied to these loans. If that loan pays off super early, obviously the value of that, we're not getting that true value of that loan. So from an investor perspective, if we're selling a loan to an outside investor and rates drop and now 4 months later that borrower wants to refi, well, obviously that investor is now going to charge us a fee because that loan paid off super early. And we now have to pass that fee on to our loan officers, which obviously they are not happy about. And it could become a pretty big cost in a fall. If rates fall rapidly, you could wind up racking up quite a bill of EPOs from both your investors, having to pass it on to LOs that in a reduced volume environment may not have the excess funds. They might not have saved those funds from when those loans closed. So we never want to have to pay back any money that we made on loans.
Is that standard practice to pass it on to the LOs, or does it vary a lot by company?
It varies somewhat. Most people that I've spoken with do pass that on. It is written in employment agreements as well. And obviously we'll try and work with anyone on a payment plan, things of that nature. But it's part of the business, and most people that we speak to are sort of used to the situation.
So Marcus, I know you're on the tech side of the house, but you work at a capital markets company. What's the chatter been that you're hearing out there right now?
Well, I think on top of EPOs, the thing that crossed my mind and things I've been talking to other lenders about really is the argument of service retained versus service released. And it's, do you want the cash up front, service released, and then run the risk of that counterparty taking your client and refinancing that borrower? And or do you want to retain? But the issue there, of course, is you don't get the cash up front. And really with servicing, it's the return of capital for your servicing mult before it becomes return on capital. And if rates keep falling, you'll never hit that initial mult. So that I would say on the capital market side is really kind of where my head was at on that topic. In terms of the tech side, I think there's a number of things. One, it's looking at your past book of business, and do you have a way with your current pricing engine to really do like a batch API process and ping a huge data set to see which loans are in the money, which loans are out of the money. Another thing that on the subject of PPE is scalability of your business. I think there's a lot of lenders out there who are not in a rush to hire right now, given all the pain that's happened last few years. So if you are not using automation, are you looking at using automation? And if you are using automation, well, what level are you using? Do you want to really crank that up? And then lastly, I think really it's just recruiting. That was a conversation we had last night at dinner. And there's some things you can solve with math, for example, like comp, rates, fees, and so on. But then the other part really is, what else do you have in your arsenal to recruit loan officers? And I think the answer to that is your tech stack.
So Ira, can you give a little color on the retain versus release decisioning, both in an environment where rates are dropping and in an environment where rates are rising, kind of the calculus there?
Yeah, so for us, when we do loan sales, we are Fannie and Freddie approved. So we are taking a look at our execution from our various investor sets, as well as the Fannie and Freddie direct price. So obviously your investor set's going to just give you an all-in price. You're going to get paid X amount for that loan, as opposed to your Fannie and Freddie execution. You're going to get your Fannie price, but you have to assign a value, obviously, to that loan, a servicing value. So what we do internally is we have sort of a threshold that we watch, and we analyze on a loan by loan basis if on a dollar amount or basis point amount that loan makes sense to hold and retain the servicing or sell off to an investor. It makes it a little tougher in these times when the investors are valuing loans higher than what we would value at. So, in this lower in volume environment where every dollar matters, it's sometimes a little harder to retain as much as we would like. We feel that some of the investors may be, in our opinion, overpaying for the servicing value, and it's tough to give that up. So, we sort of keep an eye on the investor values and make a loan by loan decision based on our various thresholds internally.
Marcus, when you're working with a company like Phoenix or MCT or some of that does servicing valuations, do you take that ad verbatim? Do you apply your own internal thoughts about the value of servicing? How does it work in terms of actually coming to a conclusion of if we're going to retain or release these things?
Well, so I'll talk about it in terms of my past work at Opus Advisors on Flagstar. We would take the servicing value and compare it against our actual performance, but there was a little bit of, kind of stick your finger in the air and do a little bit of gut check there as well. To Ira's point, I think the way we saw it is if an investor is willing to pay through what we are valuing it at, then as long as it reached a certain threshold, let's call it 25 bips. If they paid an extra mult for it, it's theirs. Like there's there's no way that we think that servicing is worth 5 years. And, coming from an IMB, cash is king. So we'll take the cash up front now. Of course, not when I was at Flagstar. Flagstar's a bank, but this was Opus Advisors. So two very different mindsets on how we looked at that. At Flagstar, we did value the relationship a lot more than 25 basis points. So we did retain that. But on the IMB front, I mean, we're not a holding company. We're here to move loans as quickly through as possible. So we took that strategy.
Ira, any color you can add on licking and sticking and figuring out where you're coming to with the retain release decisioning?
Yeah, you're always going to you're going to get your numbers, right? But there's obviously various factors. It could be something as simple as if we don't have a lot of loans that we have in our servicing portfolio in a specific state. And even though it may make sense for us to retain that, do we want to retain that one loan in this random state that now would maybe open us up to a whole new line of questioning in case of an audit, all because we have one loan in this random state. So there's always sort of outside factors such as that that play into it. But it's definitely a good guide. So as Marcus said, you're always going to have your outside factors that play into that.
So as we see rates fall here, are we seeing margins come back into play? Is the tendency for companies to go, hey, let me build some margin back in? Or is it, hey, rates are falling and I want to win as much business as possible. Let's keep margins low and try and get more volume in the door. Ira, what's the strategy?
Yeah, so from our perspective, we're not raising our company margins to just get extra income based on the rates coming down. So we're just sort of sticking with what we need to make. We're not going to raise margins again just to make extra income, especially now it's become so competitive. Everyone's fighting for every loan. So I think we are actually going to see margins decrease as rates come down, and they continue to decrease, especially on the refi side. I think it's going to be really rough in terms of keeping those margins healthy on the refi side, because this current servicers and the people trying to retain their customers are going to be pretty aggressive at it.
Yeah, Marcus, you see a lot of companies' data working at Poly, and you've also gone through plenty of market cycles before, at least in the last 15, 16 years since you've been in the business. When rates come down, generally speaking, what do margins do? What do you see there?
I think it's hard to increase margins, at least initially when rates are coming down, because the optics don't really work. There's so much news about rates falling. Let's say in the news rates are falling a quarter, right? If you raise margins in a market rally, then you have your loan officers, your customers come saying, I'm not seeing your rates match what I'm reading on the news. And I think it just creates an optics problem. Now, this is not similar to kind of peak COVID era where you couldn't raise margins fast enough to slow down volume. This is more of a gradual decrease in rates. So I do think I agree with Ira. I think it's so competitive out there right now that everyone's running pretty skinny already. And if anything, it make it even skinnier.
So I'm going to ask a question for some of maybe our people that are newer to capital markets. And so excuse me if it sounds stupid to you guys, but when I say spreads or the spread, what are we talking about in a capital market sense? Ira, where's your head go when I use the word spread? What are the specific things we're looking at?
So I take it two different ways. You could talk about the primary secondary spread. There's actually three different ways. We could talk about the 10-year versus the 30-year, the 10-year treasury versus 30-year bond spread. And then the third piece, which I tend to get drawn to, is the spread in the rate stacks. So between margin compression. So when we have our set of rates, when rates are moving, especially in volatile markets, and you're seeing the spread between 6.5 and 6 3/8 and 6 1/4, and there's no really true buy up or buy down. So it, in my opinion, it could be one of those three items, depending on which way you're taking that sort of conversation.
Marcus, pick one of the three. Help our listeners out here.
I always thought of it as the 10-year versus the 30-year fixed. That's kind of where my head goes. the coupons, my brain always went towards drops and those, I don't know.
And
30
so,
year, yeah.
well, all right, one more novice question here. For people that say, oh, mortgage rates are pegged to the 10-year, can you explain why that is not true?
Yeah, I'll go for that one. It's I mean, mortgage rates are pegged to the UMBS 30-year fix. The UMBS 30 for the 30-year fix, for example. So I would say that they're correlated in the long run, right? Like if you track the 30-year fix with the 10-year over a large period of time, they move together. But if the 10-year were to move like day over day, a certain amount, you won't see that exact same thing in mortgage rate because it's multiple components, right? You've got your UMBS price, you get your servicing value, you've got your margins. There's a lot of things that impact mortgage rates. It's not perfectly pegged with market movement.
Ira, anything to add, or can I ask my next question?
No, no, that was perfect. The other factor is the in regards to specific to that spread is there's impacts with the Fed not no longer buying where they previously were buying treasuries. And nowadays the other piece is how long the longevity of a loan. Loans hanging around for closer to the 5 or 7 year in terms of if we're looking at a comparison. But historically, as Marcus mentioned, we've still always looked at that 10-year as a sort of a long-term guide.
Well, you bring up two good points there. What is the latest chatter on the Fed's balance sheet? It was, hey, they're going to let stuff run off. There used to be talk about active MBS sales. I think that's died down a lot. Is there anything new that you've heard recently about that?
I personally haven't heard anything new recently, aside from the continued runoff. We're not going to see the Fed getting back into buying like they did during COVID times.
Yeah.
So that's definitely one thing that has that big impact on that 10-year 30 the 10-year treasury spread versus that 30-year fixed. You can't compare it when the Fed was buying, when it was a spread of 1.5, 1 3/4, and we're more in line of the 2.5 range right now, with the Fed letting that come off.
And Marcus, the other point that he made was about duration. And I want to be quick to remind people here, even if we see rates drop a little further, it's not like there's going to be some refi boom. There's such a large percent, 90% of the UMBS 30 universe has like is between 3% and 4%. If we just suddenly dip below 6, we're not going to see mortgages start to pay off in mass and a ton of refinances and all that. Can you talk a little bit about these duration expectations as we kind of inch down in rates? But it probably is going to make a huge material difference.
Yeah, I mean, if it's a slow, gradual decrease in rates, then it's kind of like the whole spec pay up math. If you're a low loan amount, you would need a large market move to trigger a refinance. That's why there's such a huge pay up for spec value. On the flip side of that, if you're seeing a quarter drop in rates, that may not be enough to trigger a refinance. So it really depends on how aggressive the Fed gets with rate cutting over the next year and what that means for mortgage rates.
All right, so I asked a couple mortgage 101 questions. We're going to move to mortgage 201 here. We're going to step up our game a little bit. Ira, I want to start with you. What should loan originators know about the securitization market? Maybe both the mechanics of it and then what's going on right now.
Well, Marcus mentioned something before that I think is really important for loan officers to know, and that's the spec environment. So, the specified pool environment right now, as the example was perfect on a $100,000 loan, that borrower, it's going to take a lot for that borrower to refinance. So what I try to explain to some of our salespeople is when they ask me, well, why is my $100,000 loan pricing better than my $125,000 loan or my $150,000 loan? Or why is my New York loan pricing better than my New Jersey loan? And I think the specified pools and the specified commitment market is something that originators should be aware of. And they could use that to their advantage as well. I think they should be aware that if they have a loan that's $175,000, or maybe it's $176,000, and they're doing a cash out refinance, maybe they can sort of lower the loan amount 1,000, get that to $175,000 loan amount, and take advantage of that spec payout at that lower level. So that's the thing that I try and explain to my loan officers, especially when they question why there's such pricing differences on those spec pools.
Mhm. Marcus, thoughts on securitizations, what LOs should know about it?
You know, when I was at Flagstar, we had a pretty active securitization desk. And I think there was always a general assumption that because we had that, we could offer below market rates. And the reality is you still have to sell them to an investor at a profit. So it's not some magical bullet out there to have like a market leading product. You just get a little more flexibility with guidelines and how you structure your program. But other than that, I'm pretty much in line with what Ira said as well.
So you're both at TMC. Has there been much chatter about that, or what have you picked up in the hallways or at the sessions? Marcus, let's start with you. What's been going on at TMC?
I've been to several sessions now where AI has been like a major talking point. And if you think about AI, it's come like when it was announced kind of with ChatGPT to now where we are today with practical business applications. I feel like that has come a long way really fast relative to just how fast the industry moves in general. And when I think about it, there's a quote I really like, and it's something like, pick the laziest person to do the most difficult job because that person will find the most simple and elegant solution. And I think that's how AI is going to plug into our industry, right? Like it can ingest a ton of data from prospects and borrowers. It can grab personalities from loan officers and customers and kind of merge the two. And I think and then you can use that, of course, with like communication, drip campaigns, whatever. But I do think that at some point, AI and the tech industry is going to run to a compliance wall. In that, if the AI is always learning, then the question is, well, what components is it taking to make decisions, or is it making decisions? And if so, are we auditing those decisions for fair lending or not? I think it can get really complicated really fast. But that's essentially what I've been hearing in the hallways.
Much like the NAR settlement, I'm sick and tired of hearing about AI, but it's here. And what I would say in talking to a lot of AI experts on my daily audio only podcast is when you think of iterations of AI, it's not like going from an iPhone 3 to an iPhone 4. Each step forward is a massive move forward. And so for people out there listening to this, I think the best way to deal with that, hey, it's moving so fast, it's hard for me to keep up. I feel like I've become a geriatric person in my 30s or 40s, is you're trying to find ways to incorporate it into what you're doing. That'll make you more comfortable with it. You'll feel like you're riding the wave versus the wave passing you by. I think that's very important there. And for me, I probably need to get over hearing about AI so much because it's not going anywhere. It's only going to become more and more ubiquitous in our lives. Ira, I don't want you to go to AI. Where's your chatter been going when you're at TMC out there? What have you been hearing about?
I wish I would have been called on first now, because I too am sick of hearing about AI. But let's sort of transition that into robotic processes, or it is a form of AI. But really that's sort of been one of the main topics and takeaways. I know you didn't want me to mention it, but really improving processes for current employees to free them up to do what they're best at. And some of that is through AI, some of that is through other technologies, but really, getting the most out of your employees. So your underwriter is not sitting there doing small income calculations when they should be underwriting files. And that goes sort of with every department. And a lot of the new technologies and a lot of the automated systems out there trying to do things like that, really just trying to eliminate the manual and repetitive work that we're sitting here paying people for right now.
What about in talking with other capital markets heads out there? What have you guys been ruminating on or sharing with each other?
Yeah, basically we're just sort of talking about various investors, their tolerances. There's some investors that go in and out in terms of their audits, in terms of when they review files and their tolerances. So it's really honing in on the best execution, not only from a price perspective, but from a long-term relationship perspective, and figuring out who the best partner is. It's no longer just an investor, but true partners. Do you keep in contact with those executives? When you need exceptions, when you need favors, things of that nature, and just trying to hone in on sort of the best outlets and execution from a whole, and not just the pricing perspective. And that's really what I've been chatting with a lot of other secondary people around.
Well, any talk about non-QM? You speak of takeouts. Is non-QM set to take off? What's going on there?
Yeah, so we had one session where a lot of people were talking about non-QM and the decision to move from brokering that business to bringing it in-house. So there's still a lot of people that are brokering non-QM business and are not underwriting it in-house. From a pricing perspective, that answer can vary in regards to the pickup from doing it in-house versus brokering it. But we decided to bring this non-QM in-house, and we found the biggest pickup was controlling the file. So we're not beholden to that broker outlet to send in loan estimate, send a CD when we need it. And so we're taking ownership of that process. And that was actually one of our biggest asks from our sales staff. So it's not, if we have to broker a loan, we have to, but we want to be able to control the process. And we felt comfortable bringing that in-house in this environment. This is not like the previous non-QM environment. These deals are pretty strong. We have a better pulse on the non-QM environment. That is something, God forbid, were to go wrong, we would just cut it off. So that was a pretty cool takeaway from one of our non-QM sessions.
Have companies figured out how to hedge it yet, or is that not quite here?
I currently don't know anyone hedging it. I don't know, Marcus, if you've heard any.
No, I would say hedging anything other than agency is agency and government is pretty dangerous. It's not a liquid enough market. It's not like you can take a pool of non-QM loans for one investor to sell to another. It's not easily transferable. So, there's really no benefit, I think, from hedging non-QM and delivering in bulk. I think that's just, you're setting yourself up for a large loss at some point in time.
Marcus, anything to add about securitizations in non-QM, or what's the chatter you've heard recently?
Nothing much on the securitization for non-QM. Just like what Ira was saying, we're seeing demand from both wholesale brokers and correspondents. I think if rates continue to dip, then I think it will be really important for lenders to really make sure that these outlier products stay in front of their loan officers. So they don't want to just focus on conforming 30-year fixes. You still need to stay educated on all your other product offerings. In the event that, there is going to be opportunity to refi those loans as well.
So in addition to me being sick of talking about AI, I'm sick of the NAR settlement. I apologize. We have a lot of fans here that were Sally people.
Look on that white line underneath the
Fans of the show.
That white line underneath the end.
What are we hearing about the NAR settlement? Like I said, I'm sick of talking about it, but Marcus in the hallways there at TMC, what's the chatter been?
Nothing really much on the specifics of the NAR settlement, other than that there's a general thought that we're going to have a lot of real estate agents become loan officers, and that may be like a trend that we see. But that's kind of it from my end. About you, Ira?
I think I heard it brought up once, and I was thrilled that it was only brought up once, because I might actually be a little more sick of hearing it than you are, Robbie. But really, I did not hear anyone really mention it in the halls. It came up maybe once in one of the sessions, but I think now that it's been going on for a couple of weeks now, we're just sort of seeing how it's going, and there's nothing really that we can do as a lender aside from education to our realtors and things of that nature. But there's nothing different that we can necessarily do until we see how it sort of plays out in a couple months.
So Marcus, I know my dad sent this question specifically for you, so you've had time to prepare here. Is there a next big game-changing thing out there for LOs that they can prepare for? I mean, Polly, maybe, I mean, you could talk about some of the stuff this $25 million is going to allow the company to do. But in general, what do you see as the next game-changing thing for LOs out there? And keep in mind, it's a capital markets show.
I know you didn't want to hear this, but probably AI.
Sorry, I didn't hear you. What?
Yeah, yeah, exactly. You know, the one thing that we've been working on that has garnered a lot of attention really is our it's Polly's AI Copilot. And one of the functions is the near miss capability, where if you're running a scenario, let's say like 75.2% LTV, our system will actually run a bunch of near miss scenarios kind of on that point, and then alert the loan officer, hey, by the way, if you put a little more down and get that at 75 or below, you can pick up like 50 bips on LLPA. And it's not, I don't want to say it's like you know, we're offloading all the work to the computer, but essentially, as we move further and further away from rate sheets, having you lose this visibility into your LLPA stack. And that has been something that has gained a lot of interest kind of amongst our customers and prospects about just where our tech is headed.
So I'm going to close with a little longer spiel here, and I'll keep in mind Melanie's words from the start about maybe I should remember breathing. MBA hosts a monthly capital markets committee. And one of the things they were talking about this month was FHFA's newly released housing goals and MBA's plan response. You know, these housing goals, they help drive the GSE's efforts to achieve their mission of supporting liquidity and affordable homeownership, these other things. But MBA is arguing that these goals have been misaligned with market conditions, and the GSEs have kind of forced these goals on individual lenders. The newest proposed rule is establishing a new process for evaluating compliance. Are these long-term plans, this is a very conceptual question for both you and Ira, I'll start with you. These long-term plans that are kind of thrown out there, are these helpful when you're worried about the day-to-day running of a capital markets department? They help you see down the river, or is it like, that's just another thing on my plate that I didn't want?
I like knowing about it, and I like, you know, sort of knowing what's coming down the pike. I can remember a few years ago where I sort of was seeing the LLPA changes, and I thought to myself, you know, I wouldn't be surprised if we see different LLPAs based on AMI income. And sure enough, what did Fannie do? They released the AMI changes on the LLPA waivers. So I like knowing it's coming. You know, unfortunately, there's nothing we could do today and right now to be prepared. I mean, we could try and be prepared, but you know, a perfect example is Fannie and FHFA defined a first generation home buyer, right? So they had a news release and they came out with a definition of first generation home buyer. So now you could sort of, you know, read through the lines that eventually we're going to be seeing something come out that is dependent upon that. So it's always good to know and see these things, even if we can't take any action now. It's just something sort of be aware of, and I like knowing about it.
So Marcus, I'll shift that a little bit for you. How do you feel about these rulemaking bodies kind of throwing stuff out there, seeing what sticks, maybe doing the, you know, that sort of thing that you talked about earlier, versus being in the trenches and the people that are actually dealing with the repercussions of this day to day? They're just kind of, I mean, they're given a comment period, but it's like, why didn't you consult with us earlier? You talk kind of conceptually about this mismatch here.
Yeah, I'll talk about kind of my experience when I was at Home Point. My boss, this was back when like LIP and VLIP were, I mean, still is a big deal, but I remember one day my boss calling me and saying, I swear to God, if you ever trade a VLIP loan, I'm going to drive to your house and punch you in the face or something. So I do think it's something that lenders just have to deal with. And I get it conceptually that they're trying to drive action, but you can't exactly change your entire business strategy to meet that. You kind of are who you are. And I think it's something that it's like, oh man, I personally thought it was just another thing that we need to think about and deal with and track and analyze and get our hands slapped maybe. I don't know if that's a good answer or not, but that's my answer.
I'm gonna give you an opportunity to give us an even better answer before we bid adieu to people in 60 seconds here. Rather than me reading some sales pitch about Polly, your favorite part of working there, You've been there for several months now. What's the best part of being there? What you're excited about with the company?
It's just an incredibly innovative company. I mean, we have an amazing team of PMs, engineers, just that it's just really fun being on the tech side of the house where innovation is the name of the game. Whereas, I have my time at Flagstar and there's just a lot of compliance to work through.
Very
I'll
cool.
leave it at that.
Great answer. And you didn't ramble, which was good. I don't have to edit anything for when we actually like publish this for the evergreen content that'll go on for forever.
Yeah,
Well,
thanks,
hey,
Robbie.
Very much appreciate the time from both of you. This is Capital Markets Wrap presented by Pauly. We will see everybody the second Tuesday of October at 3 p.m. Eastern. Thank you very much for tuning in. Hopefully there was a lot of value for you. Guys, we'll see you next month.
Thanks so much. Enjoy the game.
Thanks, everyone.
Will do.